Despite today's drop in stocks, investor Craig Hodges says the market has recovered on relief that things aren't getting any worse, and things have gotten better for Mr. Hodges, president and portfolio manager at Hodges Capital Management. He is co-manager of the Hodges Fund, which is beating 97% of its peers over the past month. Craig, welcome to Bloomberg News. Good to see you.
Thank you. Glad to be on.
What are these numbers that you're hearing telling you? What are the internals telling you?
I think the worst is behind us. I mean, we've had quite a recovery from the bottom. We were up about 40%, and the S&P's up about 40%.
And your sentiment's not from a snapshot, is it? It's from looking at things over time. Because as I was speaking to a guest yesterday, folks have a tendency to look at these things in increments, and you need to look at them quarter over quarter. Are you satisfied with what you're seeing?
Yes, and if you look at the market, it's still below where it was 10 years ago. So there was a lost decade. And so as an investor at the Hodges funds, we see opportunities over the next 2 and 3 years to not just make a little money, to make a lot of money. This is the planting season. 2 or 3 years from now will be the harvesting season. So there's a lot of chances right now.
And the last time you were on in March, you were saying that the risk ratio of reward was outstanding. Do you still feel that way?
It's less because we've had such a move. It's going to be harder from here, and we'll probably do a little bit backing and filling. But like I said a second ago, the money made over the next 3 to 4 years is going to be outstanding, and like I said, there's a lot of opportunities there.
Talk to me about profit-taking. A healthy sign?
Yeah, it is. It is. And like I said, anytime you get the moves that we've seen, that's natural. You're going to see profit-taking. But the profit with $9 trillion, or some estimations of $9 trillion of cash on the sidelines, any kind of profit-taking is probably going to be pretty well absorbed by the market.
Does that get lost in this discussion? There is a lot of money on the sidelines waiting for what?
Yeah, and that's a great point. And another thing is that the typical average investor has not been in this market. They've been on the sidelines, and so they're looking for opportunities to get in.
And you had liked U.S. Steel the last time you were on. You said if anyone believes in this economy coming back, there's tremendous growth there. U.S. Steel came out with some disappointing numbers today. Do you still like it?
Well, we had bought it in as low as $17, and around 40. It's probably, for how they're doing right now, it's probably adequately priced. But if you believe in any kind of world economic growth over the next couple of years, U.S. Steel has a big opportunity. Last year they earned $17 a share, so there is a big earnings potential at U.S. Steel. So short term, I'd say no, but over the longer term, yes.
And speaking of earnings, you want to see earnings improvement across the board. What's it going to take to make that happen?
Well, the easy earnings improvement have come through cost cutting and that sort of thing. And so you're going to need a little bit of a better economy.
Yeah, I'm just going to say, how difficult is it to do that, to take that step in this economic environment?
It's difficult, but it's going to happen. All the wheels are in motion. All the policies are in place. The low interest rates and all the things that are going to help the economy, they're out there. It's just going to take time for the consumer to kind of gain confidence and that sort of thing.
And you had looked at the last 12 bear markets, and you said when the market finally bottomed, in the first 12 months there was an increase of 36%, in the first 24 months 53%. Have we already missed out on that easy money?
Well, the easy money has been made, but as an investor you have to look at a little longer time horizon, that 2 to 3 years, and there's a lot of opportunities out there. It's a lot like 1982. In 1982, we had a similar type of environment as far with interest rates and unemployment and that sort of thing. Market took off. No one believed it. Everyone sold into the rally. The economy was terrible. Same kind of situation. The economy looks bad, but the market will go up in anticipation of that. And there's, at the Hodges Fund, we see a lot of opportunities, a lot of tremendous deals out there.
And some of the opportunities. Tell us about some of the stocks you like. The first one is GameStop. Why?
GameStop. We think a mispriced stock. Stock trades around $22, $23. Probably earned close to $3 a share. So it's trading around 7 times earnings. And they're the video, or not the kind of the game retailer. And we think that they're going to be able to continue to grow 20% plus. But yet a stock that growing 20% trades at about an 8 multiple, and that's a great risk-reward ratio for us.
What about Coinstar?
Coinstar is an interesting company. Their main business has been these where you pour your coins and get the money out, and they keep a %. But their new business is Redbox, the DVD rental for $1 that you see just everywhere. They're in Walmarts and McDonald's and 7-Eleven, and that's an industry that's going to grow. There's now the movie companies
Yeah.
are now making deals with Redbox to distribute their movies. So that's a real validation of the industry there.
And Craig, we're going to have to leave it there, but we do want to let our audience, our listeners know you also like Kansas City Southern KSU and Atwood Oceanics ATW as well.
Yeah.
Craig Hodges, Hodges Capital Management, joining us this afternoon. Craig, thanks. Appreciate it.
Thanks for your time. Appreciate it.